We just had this great debate of whether or not to, be sitting, standing, have a PowerPoint or not. And if you hadn't noticed, which of course you have, Richard's doing his best to just completely hide.
That's right. I have a couple slides for this. We're talking about series offerings, which is a new way of syndicating. And the series offering solves a particular problem. So let's imagine I've put together an LLC and my LLC is going to make an investment. Maybe it's a piece of real estate. Maybe it's a franchise. Maybe it's an exotic hypercar that I'm going to buy and just hope wildly appreciates over time. Doesn't matter. And I want to raise money for the investment. So let's do a Regulation A offering. That's great. I spend probably $100,000 putting my offering together. It takes me 3 to 6 months to get through the whole process, qualified, whatever. Finally, I can go out to my adoring fans and pitch my offering and raise. Now that offering's closed, I've got the Bugatti in a nice, climate controlled garage, and I find another opportunity. I'm going to buy another hypercar and I'm going to put it in an LLC and syndicate that again, and again, spend another $100,000 in offering costs, wait 3 to 6 months. You can see the problem here. And also, I'm probably not buying a $75 million car, even though I could raise up to $75 million in Regulation A. I might be buying a $3 to $5 million car here, or apartment, or whatever. Doesn't matter. So what the series does is it allows us to use what's called a series LLC. And a series LLC is just an LLC, but we carve it up into separate divisions, if you will. And each of those kind of acts like a baby LLC. It can have its own rules. It can have its own distributions. It can have its own business, its own self-contained business within this one LLC. I identified my Bugatti investment, and I can put that into Series 1. I can leave the other series alone because I don't know what I'm going to put in there. And then I can do a Regulation A offering and say, I've got this series. Here's the first investment. You are free to invest in it. And eventually, I might identify additional investments. And when I do, you'll have the opportunity to invest in those separately as well. And you can pick and choose which cars or which apartments or which businesses you want to be involved with, all within my one Regulation A offering. So Series 2 will do this one, Series 3 will do that one, Series 4 will do that one. Oh, I only like Aston Martin, so I'm only going to invest in Series 2. So this is a way of having one offering, one set of expenses, one, torturous process getting through qualification, and be able to do multiple syndications of basically separate investment opportunities all within that.
But you talked about it specifically with Regulation A. And it's now all of a sudden we have so many clients, so many serial syndicators that's buying apartment complex after apartment complex, strip center after strip center. And traditionally, you've been doing it through a whole bunch of Reg D offerings. Accredited only, you've got that small pool of investors. Here's a way to, I love the word democratize, make it where everybody can now invest in your opportunity. And it's done as Richard just explained. Different series, different opportunities, different sets of investors, different structures, different management fees. Everything can be uniquely structured as you always have with your syndications. But now all of a sudden you can advertise and market online, general solicit everywhere, and accept absolutely everyone as an investor. You can see kind of where it goes, blows the top off, kind of the way that you, the serial syndicator, the real estate entrepreneur, have been doing things, and really expand that base of what you can accomplish and the amount and number of investors that you can bring to the table to watch your audience expand exponentially. And I do want to bring up something because, my God, have you ever heard the unaccredited investors are the biggest pain?
I have heard that.
It's a rumor. That's totally true in a Reg D setting. But what's the average investment? What's the minimum investment that you tend to see with the Reg D?
$50,000.
And for an unaccredited investor, meaning they have a net worth of less than $1 million, you're at least at 5% of their net worth, maybe a massive amount more. Mm-hmm. For those unaccredited investors, if things don't seem like it's going perfectly, they're freaking out. That's where the unaccredited investors can be the biggest pain. Now, to differentiate it with a Regulation A or a Regulation CF, do you know around where the minimum investments tend to be?
Same as low as $100.
$100, $500, $1,000. It changes the entire dynamic. So yes, it's true from that classic Reg D syndication model. The unaccredited investors are a pain. But now if you open up the opportunity for them to invest $1,000, now it's 1%, less than 1% of their net worth, 0.1% of their potential net worth. It's just a different calculation. So now all of a sudden, it's not that big of a deal to accept all of these unaccredited investors. So that classic unaccredited investors are a pain, in my opinion, and in my experience, goes out the window entirely. That's where, again, it's going through a process of doing the overall, like the umbrella qualification. But then once we kind of go through that heavy lifting, doing the individual series underneath it is just like how you've been doing it with the individual opportunities for the individual properties, everything staying the exact same way that you've always been doing it for decades now. Except all of a sudden you can accept everyone as an investor without being so concerned about it being a pain or not. And when, the next thing that we do deal with and hear about, whoa, what about, don't want to have that many $1,000 investors. I get it. But if you go back to my discussion an hour or so ago, that's where the different classes and the different options and the different opportunities all comes into play. You can still have that $100,000 investor class that's reserved for the accredited investors, but you can now open it up with lesser terms, but still allow the smaller investors to play in the big boy games, really helping out. And that's what I at least think is truly important. Emphasizing that now all of a sudden everybody can get that great retirement plan and that opportunity rather than just the top 10% of the net worths of America. What else you got to say about these things?
I mean, it's really true how this opens up the world of investing to you, because accredited investors in the United States, depending on who you ask, are only between 6 and 10% of Americans. So like 90% of investors are excluded from these accredited only deals, or even from these 506B deals, which allow unaccredited, but they have minimums that are too high for you to get in. And I see deals where, okay, they'll allow 1 or 2 investors for less than the minimum. So maybe you can get in for 25, maybe you can get in for 10, but the opportunities are not there in abundance in private offerings or in unregistered offerings the way they are for accredited investors. And Reg A and the expansion of Reg A really changes that. And being able to apply a smaller syndication offer, this so you can justify the cost of Reg A and the time of Reg A by doing multiple offers underneath that window. It's a complete game changer, especially with the rise of social media influencers and people that are getting these, without much, without having to be like a famous celebrity or whatever, just posting content online. People are getting hundreds of thousands or millions of followers, and they can present these followers with legitimate business opportunities now. And that's incredible.
And so far, we've just talked about Reg A. And without a doubt, the Reg A is a bigger, more expensive undertaking, as Richard spoke to. But it's actually not your only option. We can do the exact same type of strategy underneath Regulation CF. Reason to do that? Well, you're starting out your career. You're not ready for the huge multifamily apartments. You're just doing single family homes. You're doing rental property. You're doing vacation rentals. You're not doing Bugattis, but you're doing Corvette. Point being, Turo. It's a Turo. Hey, we got Taha over here, our video guy. He's just running around with some awesome Corvettes. And I'm like, we are paying him way too much. But the reality is he's over there running his Turo business too. Like there's ways to make money with all of these things, and it's awesome. And now you can have your own fleet of awesome Corvettes or your neighborhood of single family home rental. It makes no sense to go through and do offering by offering, syndication by syndication, because they're generally smaller opportunities. It's just tough to make financial sense to do it all until you take this type of approach. Now, all of a sudden, you can just do that umbrella offering with the specific opportunities underneath it. It doesn't cost that much to actually get it all off the ground. And once it's set up and once it's rocking, then you can keep adding more little properties, more Corvettes, more super special bottles of wine that will go in my cellar. Long story short, it doesn't have to be Reg A. It doesn't have to be that 75 million. It's an amazing, awesome way to make it happen, but it can also be Regulation CF up to $5 million, which is a great way to start your syndication business, start your investment business in such a way that, it's tough to tell somebody, hey, I'm trying to raise $5 million for your first shot. But it's a whole lot easier to say, hey, I'm raising $100,000 as a down payment for this home. And so all of a sudden you can make all of this happen and you've got your platform to work on up to $5 million a year. That's a long runway. You don't only have to think you're limited to these massive $75 million deals. It can also be for those startups, for the guys just getting their feet wet, for you too. Final thoughts before we bring on a broker dealer and talk raising capital.
Yeah, one thing I just thought of is just to some of you may have the question in your mind, well, why not just do a fund? And so I'll just point out that funds, one, are harder to raise money for because you're saying, give me your money and then trust me that I'll find an investment opportunity. And two, by doing it as a syndication model where we have one identified investment at a time, I can have different terms. And so maybe it's my first deal. I'm going to do my first series. I'm going to buy, a fiveplex. I'm going to give my investors a healthy split. Maybe I'm only going to take 5%, give them 95. And then on my second deal, maybe I'm going to take a little more because now I've got some experience under me. And so you can adjust your terms from property to property or investment to investment as you go up, all within the same entity, which you couldn't do with fund. Just throw that in.
And just to touch on this, I know you covered it quite a bit before, but I saw a question pop up. Under Regulation A, you can raise up to $75 million. So it is kind of put on your big boy britches, but you can generally solicit, advertise, market, except accredited or non-accredited investors. Regulation CF, that is capped at $5 million per year, not $75 million. So it is more for startups, the people that are getting their footing, starting out their syndication business. I'm always a fan of learn how to walk before you start running. So the biggest difference, again, you can advertise it, accredited, non-accredited. There's different kind of process and requirements there. But the big thing, 175 million, the other's 5, they both offer a lot of the same benefits.